Let's focus first on Iran. I think we're all really focused on the military strikes. Who's getting taken out, where they're hitting, what type of missiles people are using. But really, the maritime insurance angle, I think, is the trade routes that are built upon those are the ones that are the key story here. So Matt, kind of take us through the situation and how we got here.
Yep. So key point, Cameron, you hit the lead. My takeaway on what just happened in Iran, I'm not focusing on the front page headlines that, if it bleeds, it leads, right? For the last 500 years or so in the European world of international trade that's been built up. We talked about the land-based Silk Roads being outcompeted. They become non-viable economically with the advent of maritime trade. With first the kind of the Spanish Empire, then you transition, to the um, Habsburgs, ultimately giving way to the Anglo-Dutch framework and the British Empire, which has dominated. My take on what we're seeing with the cancellation of the marine insurance policy, specifically over this war risk, is in essence an admission that these trade routes and then the infrastructure that supports them are no longer economically viable, and we'll get into that. I think there is some framing that this represents kind of a business takeover of kind of the U.S.-led, new senior partner of this Western coalition that's taking place. Kind of a foreclosure of someone's legacy franchise. I don't know necessarily that it's that, in a sense that it's a it represents like a hostile takeover type of situation, as opposed to kind of an old asset that's been fully depreciated. So, maybe this thing was like buying Sears in, 2014, 2015, where you still saw hedge funds, noticeably like Eddie Lampert, throwing, good money into that asset, that trade. Um, I don't know if this is salvageable at this point. This may be, Sears, and maybe the next thing to get on is Amazon as the horse to ride. So that's what you're looking for. So first, let's get into it. Like, what happened? All right, we all know Friday night, Saturday morning, the strikes just it's go time. Operation Epic Fury commences. The missiles fly into Iran. Missiles fly out of Iran. They hit targets all across the Arabian Peninsula. We don't have a spray chart for the maps, but they hit not just Israel, who conducted the attacks, and not so much on the naval assets that we talked about building up in the Persian Gulf, although there were attempts there. But you saw, I think the biggest surprise that hit most people was actually kind of the profligate, just spray of fire on um, Iran's peers or fellow neighbors in the on the Arabian Peninsula. So everybody saw the headline or the photos on social media. Hotels in Dubai getting hit, military bases in the Gulf of Oman. Was it Fujairah? Fujairah. Anyway, just
Something
naval
like that, yeah.
ports on the Gulf of Oman, which would service kind of the naval footprint or naval forces for servicing, reloading, et cetera, potentially in the region. You saw other hits in Saudi Arabia, where else am I? Iraq. But basically, it was just kind of profligate spray, which kind of expanded and anchored the our other parties involved in or who wouldn't have otherwise necessarily been eager to throw their weight into this conflict that has taken off. In response to that, I think that the main story from a financial market angle, besides just the spike in energy prices, the bottleneck now that is represented in the Persian Gulf as far as energy exports, both oil and LNG, to the rest of the world for demand markets. So Asia and think Asia and Europe primarily. What we saw really in response was the cancellation by these international group providers who provide P&I, political and indemnity coverage for this specific type of war risk, which would cover damage to hull and machinery. So think about like missiles hitting a ship. This would be the insurance policy to essentially make you whole as the shipper for losses of your fleet itself. Um, so that risk really was essentially pulled like what this actually represents in my mind is a market failure. We'll look at an analog of the tanker war in the 1980s, where you had the closest thing to a copy paste situation that we found ourselves in this weekend. And this was coming out of the Iran-Iraq War in the 1980s, as basically that war was just it was a meat grinder, stalemate. Both sides were throwing resources into it,
I know you're going to go
and
deep on
neither.
that, so we should definitely maybe should we
Yeah,
flip to those slides and you can start talking through the tanker
yeah,
war piece. Yeah, let's do that.
yeah. Let's go there. But anyway, let's go back one before we do that. Cover what's the band-aid solution that the Trump administration threw out. We saw this tweet where Donald Trump or President Trump uh, notifies that he's ordered the United States Development Finance Corporation, or the DFC, to provide, we'll say at a reasonable price, political risk insurance and guarantees for essentially maritime trade and energy exports traveling through the Gulf. So because the maritime insurance industry primarily operating from the western side out of Northern Europe. It's mainly London and Norway who are involved here. Then you've got the other side of this market, or the competitors would be mainly out of Asia, right? So we'll just leave that aside for now. But basically, this is in my read on this. This isn't necessarily a takeover of someone's profitable business franchise. All of these insurance contracts are essentially going to be written at negative expected value, or we can't charge a premium high enough to make these things actuarially profitable.
Right.
So what you have is the insurance industry and private risk capital pulling out of the market, and the only backstop here to keep this whole thing from falling apart is for the DFC to come in. What is the DFC itself? This is actually coming out of the Build Act of 2018, which was a Trump administration one kind of counter to China's Belt and Road Initiative, right? As this whole process, this resource war, trade war, all of that started to, I mean, it just entered the first inning, really, is what we were in back in 2018. Few of us realized it yet. This thing is now being used to backstop, essentially an insurance operation, if you will, or an insurance market that is underpinning and making possible these trade routes, which no longer look economic or economically viable, potentially, in my opinion. And the longer this goes on, the more that becomes a certainty. All right. So just to go through this tanker war background, Iran-Iraq War, 1981 to 1988. As I said, this thing was just a meat grinder. Neither side could prevail against the other. And eventually what you had was each side started attacking the tankers, like oil exports of the other, to basically raise the bar, the cost, uh, and essentially lower the economic viability of the other side's oil exports, which were entirely funding the war effort of both sides. Um, what actually happened here? All right, just compare and contrast on the left column. We got just a couple of, or just, a list of dimensions of these two situations and how they compare and contrast. I'll give the spoiler. 2026 is like an order of magnitude bigger, maybe two, like on every dimension versus what we saw in the tanker war. They list 1987, 1988, but it was like an escalation throughout all of the 1980s until it came to its head. All right. So what happened? All right. Number one, why is this time different? I would say the biggest thing is the asymmetry in cost to attack versus defend the trade routes in this point. So in the 1980s version, Iran and then Iraq to some degree uh, acting on the opposite side. Um, the vectors of attack were missiles, mines, and speedboats. We were able to defend against those relatively easily with naval convoys, right? This time around, we have this is drones in terms of in like fifth generation warfare. So on top of all those other kind of attack vectors or weapon technologies, drones are the kind of the differentiator here. You've got a much lower cost structure to wage an attack and a much higher cost structure to compete with that in terms of missiles or counter
Right.
technologies to defend. Um, so because of this technology advance that has tilted the playing field towards the attacker in the span of 40 years, we've seen the, we call this the, Lloyd's is the firm through its joint war committee, selects these zones that are war zone, essentially carve outs where the insurance policies are not valid. Right. So in the 1987 version, besides just that Persian Gulf, you had the Gulf of Oman added, which is just kind of, if you think about it, it's that intermediate mouth. You go from Persian Gulf to Gulf of Oman, and then you get into the blue ocean of the Indian Ocean, where it's much harder for the attacker to wage their attack, right? But this time around, you've seen an expansion, not just some stretches in the Persian Gulf and Gulf of Oman. Now you've got in the 2026 version we just saw this week, you had Bahrain, Kuwait, Oman, Qatar, and Djibouti added to the JWC zone
It's a
expansions where
huge
this
zone. Yeah.
cancellation of policy take place. Basically, it takes out all the oil production
Yeah.
regions and also the trade routes in between where you have to traverse to get to safety. So it makes your task as the supplier much more challenging to get out of the attacker's radius. And then here's the key thing: the peak war risk premium. And in the 1987 version, the insurance market was able to clear. Um, you had a surge pricing, if you will, and at the highest level, it was 7.5% of your value of your hull and machinery. You can also insure your cargo um, as well. But basically, you peaked at 7.5%, which take the reciprocal of that, basically like 1 out of 12 roughly. So long as you're not losing 1 out of 12 tankers here, you're going to break even um, from the insurance standpoint. What what the U.S. intervention did in between that was essentially they did some military reflagging of the vessels, but then they also provided a naval escort, and then they just convoyed the supply chains out of there. And that combination of price plus the relatively low cost of defense in terms of just it was the naval cost, right? You got to pay for the U.S. aircraft carriers and all of that to provide defense for the oil exporting suppliers to get their cargoes out onto the blue seas. The market could clear, right? This time around, however, um, the insurance industry say there is no market price that we can take these to get the market to clear. And then the proposed U.S. intervention here, the band-aid that we're going to try to get to make this market clear. Number one is the DSC takes over the political risk insurance. And then we've also proposed the naval escorts. It's TBD just based on the cost to defend yourself against the low cost of attack from drone technology if we can make this economically viable. But in my read, the fact that the P&I insurance from these 13 groups essentially make it up. They're mainly in the UK. Second would be in Norway. I think you've got one group, it's called the American group, and then one from Japan that makes up this kind of private capital pool that basically insures and
Keeps this whole
covers
thing
this
running.
risk.
Yeah.
Yeah, they've backed off, right? And so this is a multi-billion-dollar market. To do this, you have to have kind of you can't just go into this without like training or building up years. This is centuries of expertise that has been built up within the insurance industry, understanding relationships, instead of knowing how to price risk. This idea that Washington D.C. through the DFC and the Build Act can just kind of overnight spin up and know what they're even doing here, being competent at this is it's kind of a stretch,
Definitely something we need to
right?
keep watching. Yeah,
Yeah, so I think that the degree of difficulty, like this is a triple axle back, I don't know, just making figure skating, Winter Olympics analogies here, but it's the degree of difficulty is very hard, in my assessment, to keep this thing humming along. And when I say this thing, what do I mean, right? This isn't an American franchise. If you look at number one, the regional fleet of just global ships, and this is according to an IUMI research piece. They cite as a source here Clarkson's research. This is the just global fleet of just shipping vessels. It includes the oil tankers, LNG tankers, all of that, but it includes your ships, your Suezmax, Panamax, all of that are just hauling shipping containers. So it counts in here more than just oil and gas shipping vessels. But it's very clear from this graph. You see the expansion since 2000, the start of the 21st century. You kind of saw, yeah, the I grouped together all of the Asian countries. Light purple is other Asia, pink is Korea, green is Japan, red is China. Those just aggregately call this the Asian market. Blue is European, and then the gray is Americas here. The American fleet, the Americas, I think this would count the whole Western Hemisphere, but most of it is going to be just the dominant economy here, U.S. You notice the story here. The international fleet is really the growth is in the Asian market. They are becoming dominant here. The old world fleet and the trade routes, everything we've talked about on our weekly episodes the last few weeks, starting with Columbus, setting sail in 1492 to find new trade routes to make kind of Western Europe more competitive on trade versus Eastern Europe, which was kind of, Venice was the power center. That kind of window of history, all of this, international trade, economics, and finance that have built up since then, you've seen the European footprint there stagnate, especially since COVID. So in terms of this market, you're seeing a shift in power away from Europe and kind of the legacy operators for multiple centuries towards the Asian competitors, right?
yeah,
In my opinion, that is the backdrop of this story as we're seeing it kind of play out, including this weekend with a major development. Um, all right, now you get into the insurance market. Without the insurance, um, without an insurance industry to backstop your trade, none of this trade will happen, right? It just is not viable. And you see which markets are actually consuming the most of the insurance kind of segment of global capital markets. Europe, I'm following the left graph here. Europe is the leader here. It's consuming most of those capital resources. Asia is in the middle and it's trending up. And then you see Latin America and the US, it's a tiny footprint in terms of what it's consuming. So think about this like, all right, where is the European trade? Like technically it's everywhere, right? European routes, we showed these charts last week. You got the port of Rotterdam, which is the main port in continental Europe. You've got trade links there going to the Western Hemisphere through the Caribbean, connecting to the U.S. They also go, through Gibraltar, through the Mediterranean, up to Persian Gulf for exports. Then they also continue through there, over into Southeast Asia. Europe is the middle, like it connects everywhere. And so it's eating most of the capacity here in global capital markets. Asia, they kind of connect to both as well. But in terms of the insurance capital to protect the trade or make it go, if you will, or just make it viable, It consumes roughly like half of what European trade requires, and then the Western Hemisphere is just like a tiny fraction. Like it's both smaller and the growth market, in my opinion, um, but it's also much easier to defend, right? The main kind of conflict point, and this goes back to like, I don't know, the movies Pirates of the Caribbean, Treasure Islands, et cetera. You gotta defend against piracy in the Caribbean Sea, right? That's the challenge. But with the existing US Navy, it's relatively easy to do, and we just showed it in Venezuela.
Right.
We essentially police that area, and we have it on lockdown. All right. All right. So you look now at the market footprint for insurance, right? And this is why I say, is this even a good market? As a lot of people who view this as like a conflict between the U.S. and the upstarts in the Western Hemisphere versus the old world and like primarily in Europe, and this era is really a conflict between those two duking it out. There's a bigger picture to that context. My point is, why would you even want to foreclose on that empire, right? There's been some framing of what we saw this week with the cancellation by Lloyd's. Instead of viewing it as a backstop by the DFC to just keep this whole thing from collapsing upon itself, um, aggressively, like a full demolition, violent, etc. You know, put some support beams in place, reinforce it. It's going to decline, right? It's an asset that's not long for this world. But you don't want to see this thing in a complete demolition because that's going
Right.
to hurt like the collateral damage there is going to hurt everybody.
That's a key
So you
point
look
for
at the
everybody
market
there,
share.
right? I think
Yeah.
when I first saw this DFC post come out from Trump, I thought immediately this is just backstopping. We have no other plan on this. But to your point, it's making sure that as this comes down, that we're putting the structure in place to make it a controlled demolition in a way.
Yeah. So you see the premiums, North America accounts for 4.3% of whole, cargo 7.5%. This is just show like the Western Hemisphere and even the US as the largest mark-to-market economy in the world still today. It doesn't consume a lot of resources in terms of global capital to secure its own trade, right? And then all this trade we've been talking about, just connecting the dots between, say, U.S. Argentina, U.S. Venezuela, U.S. Mexico, can't whatever, USMCA. It's much lower cost. It has a competitive advantage versus this old world kind of framework that we'd be looking to defend. So why would you even want to take this thing over as opposed to just like, hey, let's keep this problem from getting worse? That's my read on this situation. All right.
So
So some other just barriers. Why we also in the US don't even have the ability right now. We don't have the infrastructure to port over what exists in, say London with say Lloyd's and what it represents as a society, all these names that come in to essentially syndicate and fund risk, if you will. Number one, we don't have any like institution or just market structure that can even compete with what's been built out for 300 years. What do I mean by that? The U.S. insurance market is extremely fragmented from a regulatory framework. It's basically like state by state. States constitutionally generally have been given control of regulation of the insurance industry. So basically, we've got 50 regulators. We don't have one framework where capital from all over the United States, all 50 states, can come in and pool and then fund this maritime insurance risk. That would take acts of legislation. It would take political buy-in that doesn't yet exist. It can someday, but these are things that take years and decades, say, of compounding. You don't just copy paste this over, and have this thing move from London to New York or London to Miami overnight. There's a lot of work that has to go into the movement and shift of capital markets to basically build out the infrastructure to make a U.S. footprint viable. That will happen, in my opinion, over the course of this century. But this is like a much longer term project than most people realize. The other thing too, so like Lloyd's of London paper is universally accepted around the world by banks who issue like letters of credit for commodity trades or just the international like cross-border capital transactions to move, say, a VLCC from the Persian Gulf from an oil exporter over to supply, say, Japan, wherever. But that kind of universal acceptance doesn't exist yet, or it doesn't exist at all for DFC instruments. Um, so that is a headwind. These things take time to build out. This is why networks like they don't port over and the value doesn't shift overnight. Generally, it's
Right.
more of like a years and decades story. The other thing too is like claims handling infrastructure. Um, we don't have average adjuster kind of headcount necessary, even existence in the U.S. labor market, probably to handle claims that will exist here, and they're getting more complex. Is kind of the background of the work as we're going through one of the hottest flare-ups, I think, in the centuries of history that has existed for this industry. Um, and then there's just the background on courts and admiralty law, special situations, understanding war risk disputes, all of that. We haven't built up any of that in the U.S. So we even if we wanted to steal this thing, if we wanted to take over Sears Holding Company in 2015, we don't even have the thing like to the infrastructure to put it in, right? We don't have supply chains, logistical, fulfillment centers,
Right.
all of that. So we can't even foreclose or buy up this franchise for pennies on the dollar. It doesn't necessarily make sense. So this is more in my move, like almost think of it as like a bailout. It's propping up this thing to give us time to move on to the next step. And this is, I think, where you see the geopolitical relationships, right? Um, so Sunday night, Monday, et cetera, there was conflict with, say, Spain not going along with, the Trump administration on trade. And you had other European powers as well who were like, no, 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 we don't want this. They folded very quickly once they realized, what everything means. Once they had that conversation with you know, their industry leads who cover insurance and capital markets from their own country or whatever. Once they get that talking to, they realize really quick what the implications were and that they fell in line very quick. So if you remember like 2008 to 2016 era, Obama, basically just international relations policy being, we're going to lead from behind. We're just going to sit back. We basically gave, in my opinion, we gave Europe 10, 15 years uh, to mess around and try to figure out how they were going to wriggle their way out of this situation to figure out what was next. That was all borrowed time. They didn't solve it. Trump administration coming in, V1 2016 to 2020, but now 2024 to 2028, they've essentially said, yeah, there's very clearly no leading from behind anymore. US is going to dictate what comes next for the West, and everybody in Europe, you're just going to have to fall in line. And by and large, that's what they've done
Yeah.
so far this
And
week.
so really quickly,
Um,
Matt, just to
yeah.
before we move on to topic two, but kind of walk us through just very briefly like Russia, and then I'm gonna flip over to this next slide here. Ecuador, how does this tie in to that kind of
Yeah.
broader framework that's happening with Iran?
Yep. So the thing with Russia, right? We talked about tanker war of 1987 versus this edition 2026. What didn't exist in the 1980s version was this call it like a black fleet. It's uninsured. It's not in the purview of this, insurance capital markets industry. Um, so if you think like it's kind of a protection racket, right? But say compare it to the auto industry for everybody. If you get in a parking lot accident, car A hits car B, your car A in this case. If car B is an insured driver and say you're on taking a US standpoint here, if you're on Progressive, car B is on State Farm, your claims adjusters, they can talk to each other. They'll do some interviews, who's at fault, all of that. And basically, like, yeah, they'll decide who pays which insurance, whatever, whose rates are going to go up next year based on who is at fault, all of that. But a solution is achievable. Everybody's kind of made whole. The insurance process works itself out. Some losses are taken, but risk is essentially dealt with properly. It works inside the confines of the system. What we've seen in the last 40 years, and especially in the last five, really, since the Ukraine war, is the build out of this black fleet, which is largely oil tankers, which are transporting Russian, Venezuelan, and Iranian oil from A to B. And they're not insured. They're not covered by this legacy capital market system, which is primarily talked about for political risk, war risk. It's those 13, call it the international groups, who do the P&I war risk policies, right? In this case, you've got a growing section of the market here in this black fleet. Think about it in your car accident analogy. When an uninsured, say undocumented driver hits you, you don't have anything to go off of. There is no process. When you call, what do? You get a police report? I don't know. Do you have some security camera footage somewhere? That helps. But you're essentially self-reporting it to your own insurance. Now your insurance has no other counterparty to work with and resolve a problem. It ends up being massively costly because instead of the risk sharing being spread between the two parties who are involved in the collision, and then say their proxies who are providing the capital to backstop, say the transaction. The transaction here is just driving, right? It becomes more and more costly for the insurance industry to capitalize or essentially fund an activity like driving in this case to take place. And we're having this problem in the United States, right? Same thing is happening like in the global insurance market for maritime, whole cargo, etc. And I think this
Yeah.
this article here you saw popping up. This was Tuesday. I want to say March 4th or Wednesday. We saw a Russian tanker. I think this was an LNG tanker just explode in the Mediterranean as a result of a drone attack that has been uh, basically placed on or pinned on Ukrainian drones, right? Who made him do that? Who gave him the intelligence to say, "Hey, this tanker was over here"? Well, guess who? It doesn't take
Right.
too long to figure it out. They were told this is a proxy by someone else in this big process taking place. But essentially, this is the same framework. Like, all right, your business franchise here, when all global trade is covered by one insurance or like an insurance capital market where everybody works together, they're happy, they work on good terms. You have relatively stable profit margins. The whole thing works. Now, it's when conflict breaks out, which is downstream of kind of the fracturing in the market from the white fleet or what's covered by Western capital markets. You could say Asian capital markets do some of the funding as well. But then there's the uninsured fleet. This thing in Russia is part of the problem. Now, two sources of oil there, we said Russian, Venezuelan, and Iranian. Two of the three, Iran and Venezuela, have been addressed here, or Iran is in process of being addressed. Russia is not. You can't just do what you did in Venezuela or do what we're doing to Iran. In terms of which civilization or society is going to be more costly to fight back again. Kind of rank order those. On the lowest, Venezuela was the easiest to wrangle in. Iran next, and Iran is very costly, right? It's probably an order of magnitude above Venezuela. Russia, you're not going to be able to wrangle them in with something like this. It's going to have to come to some sort of a business agreement is the only way that check gets settled. But this is kind of the hallmark what's going on. These were necessary milestones, in my opinion, to see a resolution to this lack of understanding, if you will, between business partners, between the West and Russia. And you could say even between the West itself, with a clear fracture taking place between US and Europe that's been developing. We'll see if there is a coalescence that can take place, and maybe Europe gets in line and starts listening to the U.S. now as the writing's on the wall.
Right.
All right, and last, you saw at the same time this week, I think this was yesterday, the U.S. opens military action in Ecuador against terrorist organizations. This is kind of that same thing. Think about this in terms of the U.S. rolling up, those relationships in the Western Hemisphere. This is kind of part of the sovereigntist movement, that whole the Donroe Doctrine, all of that. But this is, as an afterthought this week, news just doesn't have enough airtime to cover this, which is like if in any normal week, this would be like the story. Um, but think about this as basically, we talked about the Western Hemisphere and the Americas being kind of the lowest marginal cost of doing business for international trade or maritime trade. This is kind of the roll up. Same thing. All right, we rolled up Venezuela. We've got, say, Argentina flipped to cooperative. We've got Chile cooperative. We've got elections that are coming this year in Colombia, Brazil, um, political governance in Ecuador, Bolivia, et cetera, is now flipped amenable to working with the U.S. under this mindset of, Western Hemisphere only, everybody else get out. I think what this represents is this military action in Ecuador is an elimination of the kind of the adversaries to that whole narrative. So um, this kind of establishes for the going forward the Western Hemisphere nations trade between themselves, building up new supply chains, et cetera. This is a positive story for that. It tells you like this is the growth market. Um, and those blocks, the Western Hemisphere blocks, they'll trade. They'll still trade with, say, uh, partners that they deem allied and cooperative to their interests and respectful of their sovereignty, et cetera. Japan, Italy, you see as kind of early sweeps. But this is just, that whole process unfolding in real time, in my opinion.